Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today. When clients come to us and we'll work with clients, one of the big views around is yes, it's about growing their wealth and in that respect, but it's as much about protecting that wealth and protecting it from risk, so that yes, we want to get an income, yes, we want it to grow and keep the pace with inflation, but it's much about protecting that downside risk. And that's one of the things that we enjoy working with the Lonsec portfolio in particular. Often it does do that. I think that's consistent with your methodology and thinking about the protection of risk. And I suppose that diversification is a good way to protect against that from your side of things.
It is. Look, if anything that we're guilty of is that we're too conservative in terms of from a diversification perspective. And particularly, during the times where we saw after the US election, the market was up 14% in 3 weeks, and then we obviously fell behind. We're not. If you're diversified, you're never going to keep up with the market when the market does the momentum moves like that in particular sectors. So basically, the way our portfolios are structured and we try to run them is that, we in very strong markets, we'd like to keep up with the market, because obviously usually there's different dynamics of what causes those returns. So we'd like to keep up with strong markets, but at the same time, we want to make sure that we provide that downside protection to the extent that we can in those drawdowns. And I think we've been running our portfolios for a long time. I think the Aussie equities is over 20 years and the multi-asset over 10 years. And they've both been through two of the biggest drawdowns, was through the GFC in 07, 08, and during the March 2020 COVID drawdowns over those periods. And I think I'm glad to see that portfolios behaved exactly in that manner, in terms of the drawdown was less than what we saw in the market. Obviously, it's negative return; it's never good. But when the market's down 30 or 40%, no matter where you are, you can't stop that, or you can't predict or time that continuously. So the way we tackle that is basically make sure that we've got diversification and also act when we need to act. That's the other part, in terms of, you can't just put your head in the sand and think everything's going to get well. It's about making the changes, and we don't have that trading mentality. Like, we do see some of these cyclicals rally, and we knew that this was going to happen, but it's not like, we can set a position for 3 months and once it hits the price, that's a more trading mentality. This is buy and hold, diversified returns based on the risk profile, with a view of getting your target returns over the 5 to 7 year time frame.